now taking the look at the T-counts gain, we discussed earlier that T-counts within the modern day accounting systems, they look slightly modified, but essentially they have the same functionality, but it's better used along with the technology, as we mostly have the ledgers and the computerized systems nowadays. Now we can take an example of how the entries are posted in these modern day accounts. You'll generally see all the debit entries are in positive numbers, i.e. Without the callouts or the brackets. And all the credit entries are with the brackets, with the callouts. That's generally in the most of the accounting system. Some of the accounting system might not show the same. They might just show debit and credit separately in the accounts, or depending on the accounts, they might, for example, in your profit and loss account, show revenue as a positive, although it's a credit balance, and your expenses as a negative, although it's a credit balance, but they could have been modified to show the accounts in that form. But by default, you'll see in your audit trial, your debit entries in terms of the amounts, they are in positive, and the credit entries in terms of the amounts are as negative. And then when they split into their own categories in a debit column or a credit column, they are shown as the whole number. And then we can see the balance running alongside on the further right hand side. So this is modified form of the T-counts. And then looking at an example of the loan that Kelly receives from her parents. So we say first amount is the cash into her bank account or her county bank account of $100,000 that gives an asset of $100,000 in the bank account, and then she paid for the price of that is taken out of the cash account, hence reduced the balance on the cash account and bring it down to zero. So that's a quick example of how a debit and a credit in an asset account can create a difference.